Makes sense. Generally, in my opinion, the answer is no. Eric, good morning. Thanks so much for calling. You have a long-term care question, and welcome to the show.
Thank you both. Yes, I'm 53, single or divorced, and I have children. I recently sold out some shares of an LLC that I had. I have quite a bit of cash that's relatively handy. I spoke with a gentleman about it's a long-term care plan / life insurance plan.
Right.
And the premium is $100,000 if I pay it all off at one time.
Right.
Mm-hmm.
And completely vested in 6 years.
Right.
We don't need to get into all the details, but are those types of plans where it's long-term care, and if I would die before care, I would get the money as a life insurance policy? Do you guys have done those, or what are your thoughts?
Yes,
we do have opinions on that.
We have opinions on just about everything. But yes, we do. So, you're looking at the older version.
So,
right?
Eric, this is what we consider a asset-based long-term care product. The reason that they call it asset-based is because you're using your assets to fund your long-term care. With the life insurance form of this product, we find that it can be very expensive because you're buying two things bundled into one. The first being you're buying a life insurance contract, which means that there are term charges as well as administrative charges inside of that contract.
And do you really need life insurance, frankly?
Right. And
if you're trying to get long-term care.
Exactly. And if you really want long-term care, well, you're adding a rider that's going to create additional expense for you inside of the contract. The alternative to this that we have found, which is a newer version, it's still an asset-based product. You still use after-tax dollars, so that same money could be eligible for this type of product, is using a fixed annuity base with a long-term care component to it. The way this works is it's similar to a fixed annuity product in which your assets are invested in the insurance company and they credit you a fixed rate of interest.
While the
money is accumulating, you can put in a full lump sum or you can do it in installments depending. And then in exchange for a long-term care component to this annuity, they take a piece of that interest back as your form of payment. What this can do for you is, let's say you decided you wanted to put $100,000 into this contract. Depending upon your health and the questions on this type of contract are significantly less difficult to qualify for than not only life insurance but specifically for traditional long-term care policy. They could give you either double that or triple that in the event that you need long-term care. So if you put $100 in, you could be eligible for up to $300,000 of long-term care benefit.
And by the way, that is reasonably similar to the old style that you happen to be looking at. One of the which is the life insurance-based contract.
Right.
We think this is a little bit more efficient, and the other side is that there's an advantage when the money comes out.
That's right, because when the money comes out, when you are paying, when you're paying for long-term care expenses, it's not taxable. So you can avoid some additional taxation on that money. Also, what this does is it allows for a lot of liquidity. So just like any other annuity contract, you have a 10% withdrawal corridor from the premium that you initially put in every year. So if you ever needed to access that money for another reason, it's not locked into the contract, nor do you have to borrow against the contract in order to get that money. And then finally, just like with a life insurance product, this annuity will pass, if there's any money remaining, it will pass those assets on to your beneficiaries.
Yeah, so I would say that, as you're taking a look at this, Eric, the first question I would have is, do you have a need for the life insurance component of this purchase? If the answer is no, then that particular contract you're looking at probably doesn't fit you very well because, as Aaron said before, you're paying fees that you don't necessarily need to, number one. Number two is, from a liquidity point of view, we've just found that these newer annuity-based long-term care solutions are frankly more flexible for folks. They're lower cost and they can be a little bit better.
But also with those, and also with those life insurance contracts that also have the long-term care component, if you need both, you might be shorting yourself in some way, because if you start to use the long-term care rider of the contract with a life insurance product, there may not be any death benefit remaining. So if you really need life insurance and you also really want long-term care, you might want to think about separating those two things out so that way you actually achieve both goals in the event that you need either.
I like that idea. Eric, I hope that helps you. Well,
hopefully it did.
Hopefully it did. Or we put him to sleep, right?
It is always a possibility.